Welcome everyone to our solo 401k webinar. My name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. Since 2010, we have assisted over 3,000 clients and established more than 4,000 self-directed retirement plans. Our topic tonight is Solo 401k, the ultimate retirement plan. I want to encourage all of you to ask any questions that come up during the presentation. This educational webinar will have a lot of information presented. So again, if there are any questions, please don't hesitate to ask us. Just type them up in the Q&A section and we will answer them after the presentation is over. I would like to just briefly introduce our speaker tonight, Brett Synicky. Brett is a solo 401k consultant here at Sense Financial, and with a professional journey spanning over 18 years in real estate investing, Brett is not only a seasoned professional, but also a licensed California real estate agent who's dedicated to facilitating seamless transactions for individuals in their pursuit of finding or selling their dream home. His passion lies in empowering professionals to attain financial independence and affording them the possibility of an early retirement. He's a great advocate for financial success and a guiding force in the realm of real estate. Thank you, Brett, for joining us tonight. I will let you take over from here.
Okay, thank you, Natalie. Can you hear me okay?
Everything sounds good.
All right, okay. Yes, thank you everybody for joining us. Today, the topic will be the solo 401k, which we call the ultimate retirement plan. And essentially, I just want to briefly talk about our mission. So our mission is to help clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work lead to prosperity. And you work hard for your money, and we want to come alongside you and work hard alongside you to help you keep more of it from taxes and invest it wisely. So real quick, before we get into what a solo 401k is, I just briefly want to talk about the difference between a conventional versus self-directed. So the conventional is usually held by a custodian. Think Vanguard, Schwab, those types of companies, Fidelity, and you're limited to what they offer, right? The stock market, stocks, bonds, mutual funds. And this on the self-directed side, you actually control the investment. So these are just some of the options: real estate, both residential and commercial, tax liens, tax deeds. You can invest in private businesses, and you can even invest in stocks and mutual funds if that's your thing as well. The biggest difference, obviously, is you choose what you invest in. This list is not exhaustive by any imagination. There's almost no limits to what you can invest in. We'll talk about what is limited, but it's not much. And so that's the major difference between conventional versus self-directed. And I want to talk about an IRA makeover. So here we have Jason. Jason is a client of ours that came in several years ago. And before he met us, he had an IRA and a 401k through his employer valued at about $135,000. Now, his money was invested in the stock market. He was losing money. After he spoke with us, we helped him establish a solo 401k plan, and he with checkbook control. We'll talk about what that means. And he actually started cash flowing just about $1,000 a month right away. So what he did is he took his money, he bought a rental property, he invested. His brother was an entrepreneur, ran a bunch of different businesses. And so he invested in one of his brother's businesses and was getting a return on that. And then he also loaned out money for somebody to buy real estate. And so he actually became a holder of a real estate note and was getting a decent payment on that each month as well. So this is a really good example of what it is that we can help people do. So what is a solo 401k? Well, it's actually established from IRC section 401, subsection K, which is defined as a retirement savings trust. It's designed for self-employed or small business owners, hence the word solo. It's actually not a new type of plan. It's much like a simple 401k plan covering both the owner and their spouse. And this is made possible as a result of the EGTRA tax law change, which was in 2002. And that law change made many of the current benefits possible that we have in the solo 401k. I want to talk about being self-employed because that is a requirement of being able to get a solo 401k. Now, if you're on this call and you're not self-employed, hang on, because we're going to talk a little bit about, what it takes to become self-employed. It's really not that hard in this environment, in this economy that we have in 2024, to become self-employed. And I'll give some examples. The other thing is maybe your situation is going to change. Maybe right now you have a W-2 job and you're learning this is good information because maybe down the road you would become self-employed and you'll have a solo 401k in the back of your mind to come back to. So the benefits of being self-employed, just briefly, typically you're in a lower tax bracket. The IRS guidelines are written for businesses. And so typically you have a lower tax bracket for running your own business. You get to just deduct business expenses first and pay taxes last. And you get to build residual income that comes in over time for something you did one time. And you can be your own boss, which I can tell you sometimes works out to be more giving you more freedom and sometimes not. If you're self-employed, you know exactly what I'm talking about. And you get to help people. If you like what we do, you get to help people. For example, we love what we do here at Sense Financial, helping people unlock their retirement accounts and self-direct the money into investments of their choice and not have to pay hefty, sometimes custodian fees each time they make a transaction. And so we love what we do. So you get to help people. Typically, if you have a good business, you get to make more money. The sky is the limit when you're in business for yourself. Additional deductions, of course, you get your vehicle, office, etc., and you can work from home. Working from home is something that definitely has become more and more popular after COVID, for sure. But when you're self-employed, many people were already working from home way before COVID happened. So here's the eligibility. Okay, you have to have a presence of legitimate self-employment activity. It doesn't matter what the business is, but it can't be a hobby. And so if you're curious what a hobby is, you can Google IRS definition of hobby, and they have a pretty good article on that. An example would be if you love photography and you spend, I don't know, a couple $1,000 on some photography equipment, and every once in a while one of your friends wants to pay you for headshots or for photos of some sort, but you're really not making money with it. It's not a business. That's a hobby. So that doesn't count. Okay. However, for clients, we have doctors, they have small practices, we have attorneys, we have property managers. Here in California, you have to have a real estate license to be a property manager of other people's property, but that's not the case in all states. You could be a network marketer, you can do consulting. Nurses, we have nurses who work full-time for a company, it could be a hospital or other situation, as a W-2 employee. And then they do nursing on the side. They do freelance work. You can flip houses. You can be a wholesaler, day trader, contractor, and the list goes on and on. Basically, if you have income reported on a Schedule C, then you can qualify. The other caveat is the absence of full-time employees. That is a necessity. So let's dig into that a little bit more. So it's the word solo, right? So it's designed for self-employed individuals or small business owners without full-time employees other than their spouse. Leased employees are not allowed. So think a temp agency, for example. Those are considered employees. So you can't use them and qualify for this. Excluded is anybody under the age of 21 and working less than 500 hours a year. Those are the exclusions for employees other than your spouse. So here's how the solo 401k works. Okay, you have to have the plan sponsor, and it could be sole proprietor, corporation, LLC, partnership, single member LLC, doesn't matter. That's the plan sponsor. That company sponsors the solo 401k plan, adopts the plan. We create a trust. Okay, the trust is what gives you the checkbook control to avoid the custodian. Then as the trustee, And the trust also serves as the vehicle by which you're able to that holds the assets of the plan. Okay, you're the trustee. You, the business owner of the plan sponsor, is the trustee. So you take that trust, you open up a bank account, and it can be at any financial institution or brokerage. And then once you open that bank account, you fund the account, and you're ready to invest. And we'll talk more about how you can do that. But any income that comes in as a result of the investments has to go back into that bank account. Any expenses that are spent on, say, a rental property, for example, if you have a plumbing issue, whatever, has to be paid from by that same bank account. You cannot commingle the funds. So the benefits of the solo 401k, that's probably what you're here for. You're like, get all this stuff out of the way so I can find out what's in it for me. So here's the benefits. Okay. First of all, super high contributions compared to IRAs and other individual retirement accounts, even a 401k at work. And we'll break down the different portions. You have the employee side, excuse me, you have the employee side, you have the employer side, and that actually totals up to over $65,000 per year per participant. So double if your spouse is part of this with you. Proverbs 21:10 says, "The wise man saves for the future, but the foolish man spends whatever he gets." And part of this is, we want to come alongside you and work hard for you so that we can help you save for your future and actually, create multiple streams of income. So as far as the limits go, just to get a little more detailed between the difference between the elective deferral and the profit sharing. So you have, this is, think of W-2 401k. It's the same limits, right? You have up to 23,000. This is for 2024, 23,000 per year. If you're over 50, another 7,500. And you can contribute up to 100% of your self-employment earnings. So if you have a side business, again, multiple streams of income, right? So if you have a W-2 job, you work 40 hours a week at, and let's say you're a nurse and then you do some freelancing at night and on the weekends when you can, if you made $23,000 and you're under 50, you could actually contribute, if you didn't need to live on that money, you could contribute the entire amount and not pay any taxes on it. Contributions must be made within 7 days of paying yourself. Okay, so it's done through payroll or not if you're a sole proprietor. But that's another conversation. Then each plan we have actually comes with either a pre-tax or an after-tax Roth. So you can actually put post-tax income in here as well, and then invest it in the Roth. And we'll talk more about the Roth as well. And then on the profit sharing side of things, this is also tax deferred. This is an expense for the company, for the sponsoring company. Up to 20, if you're a S corporation, for example, up to 25% of the self-employed compensation could be also contributed. And if you're a single member LLC or sole proprietor, that's 20%, up to a total of $69,000 per year for 2024. Or again, if you're over 50, the additional 7,500. So you'd be able to do up to 76,500, including the catch up. And again, double that if your spouse is involved in this with you. So the example I like to give on the profit sharing, if you paid yourself, it's based on what you pay yourself, right? So if you paid yourself $100,000, max out the elective deferral, then you have 25% of your gross compensation. So that's an additional, if you're an S corp, that's an additional $25,000 that you can put into this, right? So that's how that math works. The other advantage to this is, and this is not available with an IRA, self-directed IRA or anything else, is the participant loan, okay? So you can actually take a loan out. Think of it like a bank that'll never turn you down, right? So the amortization of the loan is 5 years, 15 years if you use it for a personal residence, which you can do, but it's fully amortized, okay? There's no interest only or anything like that. It's principal and interest, and the payments can be monthly or quarterly. And the interest rate you pay yourself back, again, this is instead of going somewhere else and getting a loan. I don't, if it's a regular loan for a mortgage through a mortgage lender, or even a private loan from a friend, or hard money loan of some sort, it's going to come with hefty fees. You're actually paying yourself back. So it's interest rate. The interest rate is prime plus 1, which right now, I looked up prime, I think yesterday was 8.5. So about 9.5% is what you would pay yourself for virtually any purpose. There's really no limitations to this. In fact, oftentimes people come to us and they say, I want to do this with my solo 401k. And after talking to them, we discover that it's a prohibited transaction. However, they have enough money in the total plan assets that allows them to take out a participant loan and make that investment that would otherwise be prohibited. And so the access is up to $50,000 or 50% of the account balance, whichever is less. No taxes, no penalties. This is not a distribution. This is not an early withdrawal or any sort, but you do have to pay yourself back. And again, I said, you create your own bank that will never turn you down, and not available with an IRA. One of my favorite examples of this is we had somebody who talked to their CPA. This is before they talked to us, and they had a really high interest medical debt is what it was. And the CPA said she didn't have the money to pay it off in her checking account or some other account where the money was liquid and easy to get. But she did have an IRA, and she was thinking about taking a withdrawal. And the CPA said, well, you better take out, she owed 10,000. He said, you better take out 20,000 because it's going to cost you about 10 in the taxes and penalties for an early withdrawal. And she somehow found us, and we were able to set up a solo 401k for her. She took out a participant loan, but not for 20, not for 15, for 10, which was the exact amount she owed on the high interest medical debt. And she paid herself back the prime plus 1% and didn't have to take an early withdrawal and pay an extra $10,000. So the limits or the benefits to this are vast. So, and then the Roth, okay, we mentioned that briefly. Let's dig into it a little bit further. So there's no income restriction for the Roth contributions, okay? Just like a 401k through a Roth 401k through work, through a W-2 job, that does not have income limitations. Same thing with this, no income restriction. And the limit is the same. It's on the employee deferral side, right? So the limit's 23,000 plus 7,500 catch up, okay? Versus a regular Roth, if you do it on your own, it's 7,000 plus 1,000. Again, these are 2024 numbers. All the income and gains are tax-free, okay? You can access the contributions at any time because you put them in after it's money you already paid tax on. So if you need to take the contributions out, you can do that anytime. And then a Roth conversion. Sometimes it makes sense to take money that you invested that you haven't paid taxes on and actually convert it to a Roth and actually pay taxes on it. It's the old adage of, do you want to pay taxes on the seed or do you want to pay taxes on the harvest? And so that's something that you need to crunch the numbers on and consult your CPA about whether it makes sense or not. But that's something that some people do and can make sense in the right situation. And then I mentioned checkbook control a few times. So there's no custodian. Okay, you are going to eliminate custodian fees forever. There's no red tape, no delays. In fact, you can make an investment as quickly as it takes you to write a check. You're the trustee of the 401k plan. Okay, you're the fiduciary. You're in control. You can act quickly, and it's easy to operate. There is no annual filing requirement until you get over the threshold of $250,000 of total plan assets, and then it's a short form 5500 EZ that needs to be filed with IRS. Purchasing real estate. So real estate income and gains generated by the account, they're all tax deferred, okay? Pay taxes at a future date rather than in the year the investment produces the income. And then, of course, in the Roth, the income and gains generated by the Roth 401k are tax-free, right, when you make the withdrawal down the road. Income, again, I said this already, but you can't commingle. Income has to go back into the account, and expenses must be paid from the account. Most people come to us because they have an interest in investing in alternative assets, and real estate is certainly one of the more common ones. And you can use leverage to do exactly that. However, you cannot provide a personal guarantee. The loan must be what's called non-recourse. The property is the only security for the loan, typically about 30 to 50% down. And the bank Solera that we usually recommend has some of the best terms and rates that we've seen on this type of loan. The property's got a cash flow. It has to have sufficient cash flow, especially since it's the only security for the loan. And you must have not significant, but enough cash reserves based on the lender requirements to make the deal work. However, just bear in mind that if you do have an IRA, a self-directed IRA, it will trigger UDFI, unrelated debt finance income, on the portion of the real estate that is financed. And if you want, you can grab that URL there and look up the list of banks and private lenders that we have either used personally or vetted over the years to do these types of loans. And so you can check that out if you'd like. Now, I already mentioned this, in the IRA, it triggers the UDFI tax, which can trigger the UBIT tax, but in the solo 401k, it doesn't. So again, unrelated debt finance income, which in an IRA will trigger UBIT, unrelated business income tax, which scales up to 37%. So it can be pretty hefty. So it's important to be careful of that. Now, some people have said, and you may see it written somewhere online or whatever, that the solo 401k is exempt from UBIT tax. That is not true. It is exempt from UBIT tax on financed real estate, but not on unrelated business that you're doing within your solo 401k. So again, solo 401k is exempt from tax on leveraged real estate only. And so it makes it a tax efficient solution for real estate with a loan on it. So how can you fund the account? Okay, you can combine multiple accounts. You can do what are called direct rollovers from a traditional IRA, SEP IRA. If you are, from a previous employer, you can do 401k, you can do 457, 403b. The only exception for the rollover, which will not create a taxable event, is the Roth IRA. You cannot roll over the Roth IRA. And so this helps with true diversification. Okay, Ecclesiastes 11:2 says, "Divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth." And I think probably the most recent example is COVID. Prior to that, for those of us that have been around long enough, the more recent example was 2008, 9, and 10, when the real estate market fell apart. But you can diversify your situation by investing in using your solo 401k to invest in tax deeds, cryptocurrency. You can buy real estate. I mentioned commercial and residential. You can invest in private businesses. You can become a private lender. That's what a lot of people do, and they get anywhere from 12 to 15% back every month on their money. Precious metals is another option. So this can truly help you diversify. Let's talk about what's disallowed. Okay. So IRC Internal Revenue Code 4975 says you can't invest in collectibles. And the other thing is the S Corp, but that's only because you have to be a physical person to be part of an S Corp. So, and don't misunderstand me, please. The S Corp can adopt a solo 401k plan. They can be the plan sponsor. You just can't use the solo 401k funds to invest in somebody else's S Corp. And then on the collectible side, sorry if you love baseball cards or stamps or whatever, you can't do it. So, and then there's disqualified people, okay, under that same Internal Revenue Code. So this is the account owner and his or her spouse, ancestors or lineal descendants and their spouses, entities in which a qualified person holds a controlling equity or management interest. The exceptions are, so think about a vertical line, right? You can't invest with your mom, dad, or your kids or your spouse, okay? Brother, these are exceptions. You can invest with your brother, your sister, your cousin, aunt, uncle, or of course a friend or some other colleague. And then transactions, some examples of the prohibited transactions. So sale, exchange, or leasing of any property between a plan and a disqualified person. An example of that would be you can't sell a personal home a home that you own personally to the 401k because you're a disqualified person. If you own a home inside the 401k and you have a child that, let's say, goes to college where that home is, you can't rent that home to that child because they're disqualified. You can't even let them live there for free because they're disqualified. Lending of money or extension of credit between a plan and a disqualified person. Okay, the loans must be non-recourse, no extension of credit to the plan, no personal guarantee. Furnishing of goods, services, or facility between a plan and a disqualified person. Good example of that is you're a real estate agent and you want to buy a rental with your 401k. You can't represent yourself. You'd actually be breaking the rules twice there. You'd be breaking the rules because you're providing services, and that's number one. And number two, you'd actually be compensated for it. So that would be the other rule that you'd be breaking. Transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan. So we mentioned this already, but all the income produced belongs to the 401k. You control it, you're the fiduciary, but the 401k owns it. Act by a disqualified person who is a fiduciary, where he deals with the income or assets of a plan in his own interests. Okay, all transactions must be for the benefit of the 401k. No conflict of interest there is allowed. And then think arm's length on that. That's what that means. And then on the last one, receipt of any consideration for his own personal account by any disqualified person who is a fiduciary from any party dealing with the plan in connection with the transaction involving the income or assets of the plan. Again, my real estate example I already provided, but another one, let's say you buy a fixer-upper, you probably be tempted to do some work on it. You can't, regardless of whether you're compensated or not, because you'd still be providing services, which is a violation of the IRS rules. You can oversee the rehab, the fix up. You can hire the contractor that does it, but you can't swing a hammer. And then just some other common prohibited transactions. Engaging in a transaction directly or indirectly with a disqualified person. We talked about this already, but purchase of property from a disqualified person. Using the 401k as a security for a loan, can't do that. Guaranteeing the loan for the solo 401k, again, must be non-recourse. Loans between the 401k and a disqualified person. You can do loans. We talked about that, and that's what many people do, but you just can't do it with somebody who's disqualified. And then you can't sell personal assets to the 401k. You cannot invest in a business in which the plan participant or other disqualified person already has 50% or more ownership. Receiving any consideration for your own personal account in connection with a transaction involving the income or assets of the 401k, being compensated for services performed for it, and then, of course, commingling funds is not allowed. So that is going to wrap up our presentation tonight. If you're interested, please feel free you can jot down that URL in the bottom there. Feel free to jump on my calendar. I'm more than happy to answer any questions you have, talk through your specific situation and see what makes sense. And then if there's any questions on this call, Natalie's going to read those out and we'll be able to answer those right here, right now, as best we can.
Yes. Well, thank you, Brett, for the presentation. As Brett has mentioned, if there are additional questions, please type them up in the Q&A area. There was a lot of information, so please don't hesitate to ask. But so far, we have one question from Jay, and he's asking how RMD works for real estate if bought from solo 401k or from Roth 401k.
Yeah. So essentially, once the RMDs are required, which of course you can check the calculations on the IRS website or with your CPA on the exact percentage that you need to withdraw. You need to keep, as you get closer to that age where the RMDs are going to be required, you need to have enough liquid cash in the account to make those RMDs. Otherwise, you could potentially find yourself having to sell one of those properties.
Okay, looks like that's the only question. Just want to thank all of you for joining us tonight. If any of you are interested in a solo 401k or if you are interested in a complimentary consultation with Brett, feel free to contact him, and he'd be happy to answer any questions that you have, discuss your specific situation. But
All
once
right.
again,
Thank
thank you
you.
for joining.
Yeah,
Hope you all have
thank
a
you.
great day.
Take care, guys. My contact info's there too if you want to reach out. Thanks so much.